Gold is money. It is the most sound money available. It is the golden constant. It doesn't ever change. The confidence in fiat currencies, the US dollar, goes up and down and generally down, which makes it look like the price of gold is going up and down and generally up. So we're in a situation now where young 24-year-olds are thinking, they're getting disillusioned about saving. They don't think they'll ever be able to afford an apartment or a house. So they get involved in speculative things, speculative high growth options, investments that might be able to get them to catch up, to be able to effectively, they feel like they're swimming against the tide. How do they get that? How do they move forward? And my message is this: look.
Welcome to the Gold Exchange Podcast, where we untangle market and policy complexity using timeless economic principles. For show notes and archives, go to goldexchangepodcast.com. Now, on to today's episode.
Welcome back to the Gold Exchange Podcast. My name is Benjamin Nadelstein. I am joined, as always, by founder and CEO of Monetary Metals, and we are joined today by founder and CEO of Glint, Jason Cozens. Jason, welcome to the podcast.
Thank you very much, Ben, and it's a privilege to be on your podcast.
Jason, you got to tell us, where are we catching you today? Are you in New York City, Los Angeles? Where are you?
Yeah, well, I do spend a lot of time in New York, about 1 week a month. Normally, I think I spent last year, because that's obviously over 50%, more than 50% of our customer base is over in the US. But I'm in London. It's where I base myself, my family are. And I'm actually, we're doing this podcast from the Athenaeum Club. So it's a vulnerable club of mainly academics. I don't quite know how they invited me, but yeah, I'm very fortunate to be a member of the club. It's a beautiful building and some very interesting people, our members.
I had a chance to meet with Jason while in the club when I was in London some months back. And it's kind of a shame we didn't have a chance to record the podcast there, because that would be the one and only appearance on the podcast where I would have had not only a suit, but actually a tie.
I know. Yeah, that's one of the...
You're catching me in my natural habitat. But in London, I do don the tie.
Well, you looked fantastic, Keith. We'll have to get you back in with the tie and shirt next time.
I look forward to it.
Okay, so Jason, for anyone who doesn't know, what's your backstory and how did Glint get to help consumers invest in gold?
Okay, well, how long have you got? I'll try and keep it short, but look, for someone who's disrupting the financial services industry, I am not from financial services. Really, my background couldn't be further from financial services. I qualified as an architect originally, Ben, and actually worked in Hong Kong for a couple of years. There is one of my buildings up on Wyndham Street there in Hong Kong. I only saw it up to the 3rd floor because I came back to the UK. But when I was in Hong Kong, I kind of really got into my first computer, especially around things like visualization. And I realized at the time that, wow, computers are going to completely revolutionize how humans communicate and how they do things. And so when I came back from Hong Kong, I threw myself into the world of virtual reality. The first time it was cool. Yeah, and from there, really, my career, my company that I set up, Visuality, we pivoted into building websites, and I started hiring teams of software engineers to build some of the first e-commerce systems for the high street retailers here in the UK. So back then there were no off-the-shelf software systems. There was no Shopify or anything like that. So we had to build the content management systems, the e-commerce systems from scratch. We had to look into the future and think about what was it this emerging digital ecosystem could offer, and how could we leverage it. That was a really fun time. .com boom and going through the bust, and so my life really, I was into building virtual architecture, websites, e-commerce apps, and then 2008 happened, the global financial crisis, which some of your viewers and listeners will be very familiar with, some of your younger ones not so much. But that, for those who don't know, Keith, I mean, you'll be able to describe this better than I can. But from my perspective, we came to the verge of complete collapse of the financial system. And if you listen to some of the chancellors, the Fed people, talking about it now, in hindsight, we were literally hours away from a complete breakdown in the banking and financial system. And so for me, like I think a lot of my clients, it was the first time that I realized that when you put your money in the bank, it ceases to be yours. That money is lent out. It is given to people. It's put at risk. And there is no money in the bank. If we all ask for it, there'd be a run on the bank. There'd be no money to give to its clients. And so I thought, well, hang on, I'm not that bothered about the small amount of interest I get from leaving my money in the bank. What is that risk-free deposit store of value? Where can I put my money where it's not put at risk? And actually, the whole banking system really it's a farce, kind of hiding in plain sight. I mean, when people talk about risk to me, they sometimes talk on the know in great detail about the risk behind systems around vaulting, etc. But actually, the banking system, people put their money in the banks, and yet it is the biggest. There's nothing there. It's the emperor's new clothes. But of course, when you start thinking about that, you start thinking about other related issues. And of course, the other big one that came up in my mind was the fact that money does not buy you what it used to buy. And I think you don't have to be very old to start realizing that when you were younger, something would cost X, and now it costs X times 3 or X times 10. Why is that? Have these things got bigger, better? Have they? What's happening? And of course, the real shocking realization or real shocking truth for me that really came back, and I'm going to have to say this about 4 times just to let listeners really let it sink in. And actually, on your podcast, they probably know this already, but the US dollar at the time had lost 85% of its purchasing power. And now I think it's 90%. And that's like, wow, we're using a form of money that's become worthless nearly. And of course, it's not just the US dollar, it's every fiat currency. And I learned that up until 1971, we'd been, the dollar had been backed partially by gold. We had a relative gold standard, and it was, Nixon temporarily took us off the gold standard. It's supposed to be a temporary window. Yeah, temporarily. And we're still in that temporary window. And of course, because the US didn't want, my perspective on it is that the US didn't want to lose its gold. The French were busy going into New York Harbor with their warships, asking to exchange their dollars for gold. Fort Knox was going down. How far down, we don't know, of course, because I don't think there's been an audit since, or many. And we came off the gold standard, and so I was introduced to gold really through that process, through that thinking. And I thought, well, I looked at gold, and gold still buys you what it did 3,000 years ago, never mind 50. So why don't we just put ourselves onto our own personal gold standard? Why can't we enable gold as money in electronic payments? I thought to myself, every day I was kind of looking at things differently with the thought of how can we do this better? How can we do it more efficiently? How can we do something new in relation to an industry using this emerging digital ecosystem? A bit of a curse, really. I literally looked at everything I did. I was thinking this way. It was an obvious thing for me to do, was to think, well, why can't we just enable gold as money? If it's no one else's liability, if you're buying the right type of gold, if it's safe, if it's reliable in that regard, if it has been money for thousands of years, why can't we use all this tech to be able to use gold as money? So that's what we did. I was delusional enough to think that I could make that happen. A lot of people said I wouldn't be allowed to, or we wouldn't be able to, but perceived and persevered. Sorry, and yeah, we've that's what we've done. Glint now for a number of years, has been enabling gold as everyday money. We're the first company in the world to enable money in electronic payments with the Glint app and with the Glint MasterCard. So you can literally buy gold, $10 worth, $1 worth. You can save it, you can send it to other people that have Glint accounts, and you can spend it anywhere in the world. So recently I did my little, Keith, you were over here in London and went on to different places around the world. I did something similar. I was in Dubai and Switzerland and Auckland recently, in Sydney, and I paid for the whole trip, of course, with gold. And it's doing its job for me, and for a lot of our customers believe in it too. So I'm happy I don't want to waffle on too much about it, but I really do believe that the monetary system is one of the biggest reasons why we have so much inequality in the world. And I believe in a world where everyone has an equal opportunity to prosper. I don't think the game should be, the dice should be kind of stacked in the favor of one set of people. And of course, the way money's created through debt and through lending, of course, those with money can borrow as much as they want and buy assets, and it's creating an increasing divide. I don't think it's right that because of that, 3 people in the US own more than 50% of the other half of the US population. And I think those distortions are wrong, but I don't think central banks are going to do anything about it anytime soon. So I think it's up to entrepreneurs and individuals to look at ways in which we can opt out of that system and effectively put ourselves on our own sound money systems, whether they be crypto or gold based or whatever.
Well, Jason, I always find that so interesting because people always scoff at this idea of gold. Oh, you want to go back to a gold standard? Let's get our, coin purse out and have some coins jingling on a rope belt. And we're going to walk around and, what, you're going to pay with a gold coin? That's ridiculous, right? Well, maybe Keith, we'll start with you. What do you think can change the perception of gold as a monetary medium, as a monetary kind of piece of it or asset or instrument versus the dollar or something else that most people think, well, that's money?
I just wanted to first add a comment about the imminent collapse of the financial system. And what sticks out in my mind is reading an interview with this woman, I'm trying to remember, I want to say Carmine something or other, who's an attorney who was some sort of assistant to then Treasury Secretary Tim Geithner. And she was talking about in the days, where the crisis was erupting, and they had these very intense meetings, and basically Tim Geithner ran from the room and went into the men's room and was just, sobbing, and he came back and he said he felt like he wanted to throw up. And that was the leading leading minds allegedly, who shepherded the economy before the crisis. They used to call it the not just the new economy. What was the term?
Well, there was the Great Moderation, Keith.
Great Moderation. That was the term I was looking for. Yes, the Great Moderation that they had created. And when the Great Moderation turned into a great crisis, they wanted to run from the room and go throw up. And these are the people to whom everybody blindly entrusts their faith and their belief that these people got it, it's all good, and all we have to do is worrying about the next consumer purchase we want to make or who's winning on the sports game. So your question was, what does it take to change the perception of gold? Partly, I think it's to present gold as a more serious, more adult thing. That's why I've been as aggressive as I have about attacking and debunking the various conspiracy theories. The latest was, I don't know if you saw this, Jason, what was it called? Something with Corner got a little spot on Australian broadcasting company saying that the Perth Mint had sold, quote, diluted, unquote, gold to the Shanghai Gold Exchange. This diluted, now the body of the article acknowledges the so-called diluted gold was, in fact, better than 99.99% pure. So the concept of dilution and the concept of 99.99. Now, most people, unless you've taken chemistry lab at the university level, may not realize that every little bit of additional purity you're trying to get, whether you're distilling alcohol or refining gold, is exponentially more expensive. There's no such thing as 100%. There's always an impurity, because to be exposed to the air, you're getting some impurities, little bits of dust are landing in your molten gold or whatever. And, people make much ado of this. And according to the article, it wasn't that it was impure gold, although the headline said diluted, but the issue was that what was in the 0.01, which is a tiny fraction of the total weight of the bar, obviously, but within that 0.01, the specification provided by Shanghai for silver was exceeded, had too much silver within that 0.01. And I'm like, man, if there's something that smells a lot like a nothing burger. That surely has got to be the nothing burger. And so Shanghai Gold Exchange came out yesterday with some sort of announcement that said this is false, and the Perth Mint and the Shanghai Gold Exchange reserve the right to take all legal actions to preserve our reputations. I was like, okay, well, that's the bun for the nothing burger. I think we need to get past all this stuff, and then I think it's about you know, and I like what I'll say it the American way, what Glint is doing. I think you British would say what Glint are doing. It's a plural for a company. And you study maths, which is a plural, and we have math here as a singular. You know, I like what Glint is doing, because you're building the infrastructure to allow gold to be used, you know, in a certain sense, in a conventional way, right? Which is, okay, I have money and it's parked over here, and then you know, if I want to spend my money, I can, and you're just enabling that. So we're not back to the medieval period where, you know, you have to walk around with a little leather purse jingling on a rope belt on your robe that you wear around. You know, it's on your Apple Wallet or whatever it is, and so it has very modern accoutrement to it, but it's gold rather than you know, bank liability, which, you know, Jason, to your point, the bank liability is a return-free risk, and the risk is opaque. It's unknowable. I'm not even sure the CEOs of the banks actually truly understand the derivative book and what a disorderly unwind, you know, might look like. Certainly the regulators don't understand it. Certainly the public doesn't understand it. Anyway, so instead of that, you know, you have gold. All that makes sense, and it will help people become familiar with gold in a different context. Obviously, monetary metals, we're doing something that I think is necessary, which is, if gold is money, if that's the thesis, then money should be able to earn a return, and not just because it's going up in terms of a falling fiat, but actually generating, you know, more money.
Well, it's funny you should mention that, Keith, because I was at, let's just call it a conference of the gold industry. And I met somebody who told me that, you know, he had been the chairman of this venerable club of people from the gold industry. And when I told him what I did, he said to me, he tried to kind of, you know, pop holes in it. And he said, well, you know, gold doesn't give a yield. And I said to him, yes, but neither do dollars or pounds give a yield. You know, if you stick them in the vault, as we do with our customer gold, you know, they don't give you a yield either. And
Right.
of course, you can decide to choose to put your pounds or dollars with an element of risk, you know, if you want to get a return. But of course, you can do that with gold too. I mean, you know, what he had nothing to say, but I mean, it's this. I think it's this. You know, 50 years of temporarily coming off the gold standard has somehow made people think that gold isn't money anymore.
I'll let you rant.
Yeah. So this guy who's Gold Central, he's the good old boy of the Good Old Boys network of gold.
Yeah.
You know, completely dismissing doing anything new with gold. He just wants to keep it in stasis, you know, as it was, and not change. It reminds me of a very sad expression, which unfortunately is all too often true. And the expression, or the saying is, or the quote, and I don't remember who said this: science advances one funeral at a time.
Yeah.
Now, I don't wish anybody will, you know, ill. I think in this case, it's not going to be a funeral so much as, you know, we, the Gold 2.0 companies, will just move the ball forward, and the old guard will be standing there, you know, in the 10-yard line, you know, just sort of out of the action, off the camera, you know, kind of wondering what the heck happened. But you know, I had a very similar experience, Jason, when you said a lot of people said they won't let you do it and can't be done. And, you know, in the US, they point to cases like Bernard von Nothaus and what's his name, Douglas Jackson, you know, and these are people who made pretty obvious legal blunders. You can't stamp a coin and put a dollar face value on it, as
That's right.
Bernard von Nothaus did. You can't flaunt the anti-money laundering laws as Douglas Jackson did. And so that, they point to that, so they won't let you, they're going to shut down gold. And it's like, no, look, there's a bunch of laws you got to comply with. I don't necessarily agree that those laws should be, but if you're going to do business, then that's just the environment. You just have to build, compliance, team and a
Yes.
compliance process, and you just have to do it. And if you do all those things, then nobody shut you down, nobody shut us down.
And that's that's what we've been very much adopting and embracing the regulatory environment since before we even started. So we are regulated by the Financial Conduct Authority, part of the Bank of England, and it's painful, and it means that you have to spend a lot more time and money on things, on setting up the processes and the governance around your company. And actually, we were able to do this even though gold itself isn't regulated by the FCA, because we're dealing with client money. And I, as you say, sometimes you don't agree with, we don't agree with some of the, the centralized government initiatives that are there to protect us. But in this particular case, it's very frustrating to be doing this and watching, for instance, a lot of people in the cryptocurrency industry, running roughshod over these regulations. And I kind of see the regulatory clampdown that's been going on with crypto, who, by the way, are my friends. They have a similar vision and mission, I think, for the world. But it's no surprise to me that we're seeing a big regulatory clampdown on this, and it's not I don't think there's some big conspiracy as to some requirement not to let cryptocurrencies take hold. I think that they generally believe, these institutions, that hang on, we've been set up to protect the needs of the consumer, and when things like FTX happen, and of course they've been caught off guard, and they need to make sure that these companies are all playing on the same level playing field. And really, that's in a way one of the reasons why I'm quite glad that this regulatory leveling up is happening, because either you get rid of all the regulations or you make sure everyone's complying with them. But it's not good to have a situation where it's different for different people. But going back to your question, Ben, I think it's also a matter of perspective. It's no coincidence that I was in tech for a long time before I kind of came across this issue about money and about the monetary system and gold. And it's no coincidence, I don't think, that certainly to start off with Glint, our early adopters were older, typically 35 and 40 up. And we're definitely reaching a younger audience now. But perspective is really important. As I've got older, I've realized how quickly life goes by, and actually how short our lives are. I'm 52. I talk about when you came off the gold standard, that was in 1971, just 50 years ago. It is nothing. I was in Sydney seeing my friend the other day, and I realized I felt like I'd only been gone 3 months. It had been 9 years, nearly a whole decade. And yet, if you're a young 35-year-old person and you haven't read history or don't have any interest in history, you have no idea what the norm is like. So you have no idea what normal interest rates are. You have no idea what inflation is. You have no idea what gold is. And it's kind of like, because for this tiny short period of time, that this is how the world works now,
I give a talk at there's a simpatico company here in the US that organized a seminar, and I gave a talk, and the person at that company who kind of did all the event planning and everything was administrative assistant of some sort, and she was, I don't know, 23 or 24 years old. And a lot of my talk was about the interest rate, the collapse of the interest rate, post 2008. Nobody can earn interest on their money anymore. She came up to me afterwards. She said, "I've never thought about it," because basically the entire time that she's been aware. I mean, one becomes aware of these things, I guess, before one turns 21, but let's call it 14 or 15 or something like that. There hadn't been any such thing as interest, and she just thought that that was life, that was normal, and plan around it and whatever. And she had a little bit of perspective that, yeah, before 2008, there was actually interest, not a lot, but something. And everyone just takes for granted today, and recency bias takes over, and yeah, it's normal, right?
Yeah, recency bias. That's a phrase I think I learned from you. It's a really interesting phrase. I think people mix up, the kind of perspective they have and the surprises they get from recency bias with black swan events, which really should be two very different things. It's not really that surprising that we're having inflation now, and it's not surprising that we have normal interest rates again. These are not black swan events, but for a 34-year-old or a 35-year-old, many of which are in very influential positions. I know in the, many of our world leaders and local leaders are now, coming into power at quite young ages, which is good to get young blood into politics. But of course, there's no perspective there unless they've taken the trouble to understand, to get the perspective, which I think people need. And obviously, as you get older as well, there's a tendency for a lot of people to get set in their ways, which is what you were talking about before, Keith. And somehow we need to get that married with the creativity and the flexible mindset of a younger person. I'm not quite sure how that happens.
So
I suppose
we're screwed. We're totally screwed because the young people don't have the perspective, and the old people don't have the flexibility to change their thinking. So I'm just
Keith,
kidding.
your honorable host is 24 and is into gold, and is still flexible. Hopefully, can't touch my toes, but flexible in other ways. All right, so why don't I ask you this? Let's say I am 24. I've never heard of this whole gold thing before. I've heard of meme stonks and, crypto, and I don't know, you guys are old heads talking about gold. Why don't you each give me the 1-minute pitch? Why should I have gold? Is it a good financial option? I've never heard anything about gold. Today's my first day. Jason, we'll start with you.
Let me just interject one thing. Don't call us boomers.
Okay, Keith, you're not a boomer.
Jason's 52, I'm 55. We are Generation X and proud of it.
Okay, Generation X. I'll start with Jason. Jason, give me the 1 minute.
Well, first of all, I don't think gold's an investment. So let's get really clear. From my perspective, stocks and things like that, you are investing in a company which is run by people. It has a thesis that it might grow. You are definitely putting your money at risk. That money could all go to zero if that company goes bust. And so, we've seen 85% falls in stock markets before. You can certainly see 100% falls in individual stocks. These are risk assets, right? Which you're investing in. Gold is money. It is the most sound money available. It is the golden constant. It doesn't ever change. The confidence in fiat currencies, the US dollar, goes up and down and generally down, which makes it look like the price of gold is going up and down and generally up. So we're in a situation now where young 24-year-olds are thinking, they're getting disillusioned about saving. They don't think they'll ever be able to afford an apartment or a house. So they get involved in speculative things, speculative high growth options, that investments that might be able to get them to catch up, to be able to effectively, they feel like they're swimming against the tide. How do they get that? How do they move forward? And my message is this: look, absolutely, download apps like Robinhood, get involved and looking at how you invest in businesses and stuff, but be very clear about the difference between that and sound hard money. Gold is the choice for me if you want to save your money and you want to make sure that its purchasing power of the long term doesn't decrease. You might find that in 10 years time or 20 years time, when you've got gathered enough gold, you'll be able to have a deposit for an apartment that you've always dreamt of. Whereas if you just saved it in US dollars, pounds, or euros, or whatever fiat currency you're in, I can just about guarantee it'd be worth a lot less than it was previously. So don't put all your eggs in one basket. Make your investments if you need to. I would also say dollar price average. Don't just go out and save up your money and then buy as much gold as you can. As I said, it might be a time when the fiat currency has got a lot of confidence behind it, or not. You might be buying at a high price or a low price. Just buy a little bit every month. Why not? And then when you need to spend it, you can do. And it should have, and more often than not, it would have kept up its purchasing power. And make sure you're buying real gold. I mean, there's a lot of stuff out there, unallocated gold ETFs that are or tokens that are backed by gold or supposed to be backed by gold. I always say make sure you're buying real allocated gold. And of course, if you want to get yields on that, then that's over to you guys. But
okay, Keith, your turn. You're not a boomer, but you're definitely older than 24. So give a 24-year-old advice. They've never heard of gold. Maybe they'll think about investing after they hear it from you.
I think it really starts with an education, and it starts with and I 100% agree with something Jason just said, that gold's not an investment, it's money. Now, in the context of investment, what's money? Money is the thing that you want to hold when you don't actually want to invest, when you want to sell your investments and not be invested, not taking the risk, not exposed to systemic risks and crisis and whatever. When you sell and you want to cash out and just hold money, money is the not investment. It's the not anti-investment, but it's the thing that when you're not investing, you're holding money. And that should lead you down a conceptual, almost epistemological path. Okay, well, what does that mean? What's the difference between a stock? I mean, I can sell my stock and buy consumer goods with it, especially if somebody were clever enough to hook up an API to my stock account and let me spend my stocks. Or I could have an ETF of a basket of stocks and then sell that down. What's the difference? Why is stocks not money? Well, as Jason said, counterparty. In order for something, money is the thing that there isn't a counterparty. Money is the final payment to extinguish a debt when there isn't anybody else. You're literally taking your marbles, getting up, brushing off the sand, and leaving the sandbox and going home, taking your marbles home. Well, why is that important? And when does that matter? And there's a whole conceptual set of things. The Bitcoin people, and I agree, Jason, a lot of what started their ethos is very similar to what we're trying to do. But then a funny thing happened along the way, which is number go up. And the more the number go up, the more that it's, first of all, attracting people that don't have any idea and don't care what the original ethos was. It's now about rolling the dice. Baby needs a new pair of shoes. Come on, let's go. And and they start to say all these things, which are very glib and just smoothly roll off their tongue. And you really have to have a thoughtful response when they say, well, Bitcoin is self-custody and gold you must custody in the hands of somebody else. Now, first of all, you can obviously hold your own gold in your own hand, as you could with your Bitcoin, sort of, except in Bitcoin, you're not holding the Bitcoin. The Bitcoin, to the extent that it exists as a number in a database maintained by others. You just have a password that unlocks that record. And so, you have to think about this at a deeper level. And as you do, you come to realize why gold always was money long before the baby boomers, and continues to be money long after the baby boomers. And I'll just add one thing. Jason said, the golden constant. I point to the fact, I had a debate with a gentleman. Did you see the debate, Jason? I debated Pierre Rochard, one of the leading Bitcoin voices, under the auspices of the Soho Forum.
I haven't listened to it yet, but I'm going to.
And I put up one slide. Like, we had an opportunity to put up slides if we wanted. I just brought one slide, and it was a slide showing the price of gold for 5,000 years, and it was just a flat line. And I said, look, this is not just haha, we're being funny, 1 = 1, A = A tautology. This actually means something, and what it means is that for 5,000 years, we've been accumulating gold. It's the only commodity for which there's no such thing as a glut. We just accumulate it without any particular limit. Now, economics teaches us that commodities have a value at the margin, a marginal utility, which diminishes as the quantity goes up. That is, each additional unit, whether it's oil, whether it's wheat, whether it's cotton, whether it's copper, each additional unit is worth less at the margin, until a glut is the point where the market value actually falls below the cost of production. Nobody can make any money producing it anymore. They have to shut down production. Of course, that incentivizes additional consumption until the glut is worked off. But it's not true with gold. That for 5,000 years, we still produce gold. Its value hasn't fallen either at all, I would argue, or if it falls so slowly, it might as well be a flat line. That the value of the nth plus 1 ounce of gold is the same as the value of the nth ounce, which, if you think about it, that's exactly what you'd want a monetary unit. Now, we're not talking about, in this case, savings, we're talking about economic calculation. The most fundamental and important calculation in economics. Economics has to explain how the firm does this. Is the firm has to know whether it's creating or destroying wealth, which means it needs some sort of arithmetic, some sort of calculus to say, okay, we operated for a year. Are we richer or poorer than we were before? And if you're counting your richness or your poorness in terms of grains of sand, molecules of water, but even bales of cotton or barrels of oil, well, the values of those things can go up and down so much that they can go up or down more than whatever the net change in wealth of the firm is. So you need an objective unit to measure, things like wealth creation in the firm and profit and loss, especially in long-term, businesses where you have long-term financing, you have debt capital and equity capital. You're not just looking at, a kid opens a lemonade stand, for a day and buys, $5 worth of ingredients and sells it for $10. It's easy to know whether the kid made or lost money. But now let's say you want to borrow money and operate a factory for 30 years. How do you know at the end of 30 years, you paid $100,000 for the factory in 1993, the factory is now $1 million. Is the factory worth more? Or is the monetary unit with which you measure the factory, worth less? And because gold has demonstrated that the n+1 unit is valued the same as the nth unit going back 5,000 years, then gold is the way you perform that calculation, which avoids the booms and the busts and avoids the need for the Geithners of the world to have to go run to the toilet and feel like they want to vomit, to tie that all together.
Okay, you convinced me, Keith. I'm 24, but after hearing that speech about gold, I'm so in. Gold is money. It's not an investment. Okay, I know we're about to wrap up here soon, but I kind of wanted to get to a bunch of different topics, kind of get your lightning round, quick thoughts on a bunch of different topics, from the UK to the pension system, to funding, to rate hikes. So I'll kind of ask a question. I'll each give you kind of a quick short minute to explain what your thoughts are, and then I'll go to the other participants. So we'll start with you, Jason. Have you seen how rate hikes are affecting, let's say, your business personally or businesses in the UK? And do you think that because of that, the Fed or the ECB is going to have to turn around and pivot?
Look, I think that the winds of inflation and the winds of recession are conspiring to create a storm that the Fed, it's impossible for the Fed or any other central bank to battle or fix. Of course, we all know that in order to battle inflation, the Fed is increasing interest rates. Of course, that creates recessionary pressures on the environment. Businesses, people are becoming under increasing pressure as their cost of money, which for the last decade or so has been free, suddenly they're realizing that it comes at an extreme, at a lot bigger cost. Of course, to fight recession, you need to do the opposite. You need to loosen monetary policy, print more money, and lower interest rates. So the two battles are in complete, the solutions are in complete opposites. So we've got this storm that's been brewing with that. At the moment, I see the Fed, being very robust about its interest rates. I can't see it happening, continuing in the long term. I suppose the US has the advantage over a lot of other economies in that it's a bit more buoyant. It can create its own money as well, and it's benefited from that over the last period. So it's a stronger position than most. But I see, look, businesses are going to be going bust, and so are people. I mean, people's mortgages, up until now, they maybe haven't had to renew their mortgage. And when is their mortgage renewed? Is that, is the majority of people's mortgages going to get renewed, coming up for renewal next year? At what point? At some point, that's going to happen. And the Fed is not going to allow people to lose their homes on a mass scale. They're not going to allow businesses to go bust. And yet all this free money up until now, these junk bonds, so to speak, have been propping up inefficient businesses. There's been a massive inappropriate allocation of funds into the economy. It's all going to shake out. And so at that point, I think they will have to pivot, and they will have to lower interest rates, and then we'll be back into a battle then with recession. And I think we're going to ping pong between the two problems for the next 10 years.
Keith, I want to hear your take. Do you think that the way that these rate hikes are destroying businesses, leading us towards a recession if we're not in one already, do you think they're going to have to pivot?
Yeah, absolutely. I was going to say to Jason's comment about some of the differences between the U.S. economy and the rest of the world. I'm trying to remember the statistic, but the majority, or if not vast majority, of residential mortgages in the U.S. are fixed rate for relatively long terms, and that's not true in the rest of the world. So rising rates aren't necessarily going to hit homeowners in the form of higher monthly payments. However, it's going to hit them in the form of lower home values because people, most people who buy a home are payment buyers, they don't really care what the price is, they care what the payment is. And so, with an interest rate now, what it is versus what it was a year ago, people can afford a lot less house. So once the comparables start to fall, I think a lot of people are going to say, I'm so upside down on this house. It's called jingle mail. They put the keys in the mail and send it to the bank and they just walk away. That was commonplace in 2008, 2009. And I imagine we're going to see a lot of that. So you have two problems. The creditors are going to be in a bad way because the debtors will be defaulting on all sorts of things. We already see the statistics that subprime auto loans have rapidly rising default rates right now. I don't think there's yet data showing rapidly rising mortgage defaults, but I imagine that will be coming in the rest of the world as the payments go up. As far as business, people talk about the crowding out effect of the government borrowing. Right now, if the government is saying, hey, we're going to pay you on a short-term treasury bill of, call it 5%, and now the Fed is actually threatening to hike that even higher. So let's say the 1 month T-bill is paying 6%. Well, a business, in order to get that investor to say, I'm not going to lend to the government at 6%, I'm going to lend to this risky small to medium enterprise. What interest rate does that risky small to medium enterprise have to offer in order to get that capital? Well, it has to be a hell of a lot higher than 6%. Now, the problem is, for decades, the interest rate's been falling. And every time the interest rate ticks down, it enables the next marginal business to open up their new store, their new plant, their new dock, warehouse, whatever, and expand, supply, expand production, which means that they pull down, as long as there is a positive spread between the marginal return on capital and the market rate of interest. And then the rate of interest is being manipulated by the government, so it's not subject to a free market and the forces that would occur in a free market. Then you're just pulling down the return on capital. So we've spent 40 years pulling down the return on capital. We've spent over a decade at effectively zero interest rates and pulling down the return on capital across the board to marginally above zero. Now you say, let's hike the interest rates to 6%. Well, nobody's return on capital is suddenly skyrocketing to 6%. And so the only way to rectify that is, as the cost of borrow goes up, firms are either going to liquidate their capital stock in order to repay their debts and effectively try to deleverage somehow. But if the entire economy is full of a one-sided trade where everyone's trying to deleverage, then that doesn't work, or they just default. And bit by bit, all this production capacity has to be destroyed, which, if you're interested in lower consumer prices, we're talking about massive destruction of supply. That's not necessarily going to do what people want. Anyways, I apologize. That was a longer answer. It's supposed to be a lightning round.
That's okay. Okay, we'll do one more quick lightning question, which is, okay, a lot of people have said, Keith, Jason, yes, you're right. The monetary system has issues. And the way we're going to fix those issues is that the governments and central banks are going to offer a digital currency. This will help put interest rates lower if we need to. We can make sure that people have safety of their deposits. You can always check on your phone and say, hey, listen, my digits say that I have my money right here. You can send it back and forth to each other. What do we need gold for, Jason, if we're going to have a central bank digital currency?
So I think central banking digital currencies pose the biggest threat to civil liberties we've ever had. First of all, why is that? Well, I think it's a problem at best that's trying to find a solution that doesn't exist. And at worst, as we've seen in China, it's a method of mass control over citizens and population. Why do we need it? We already have innovation within the financial system around things like cross-border transactions and new and interesting ways of making payments, etc. But of course, I generally think that people within this the central banking digital currency world have the best intentions, but the problem is if something's corruptible, eventually it will be. These CBDCs will become programmable. They won't be able to resist it. That means they can control. They'll say, hey, and it'll all happen at the next crisis. They'll say, listen, we now can just be able to inject money to the people who need it most, because now we know everything about you. We know what you spend. We know how much money you've got. We know what you spend it on. And so we'll only be able to give these credits to people who really need it. And so please, sign up to central banking digital currency, and we'll make sure you'll get your welfare payment in this terrible situation that we're going through at the minute, whether it's a pandemic or whatever it is, whatever crisis it will be. The problem is with this, they'll literally know everything about you. They'll know more than they've ever known about you. They'll know all your spending habits. They'll be able to say, hey, Jason, I'm sorry, you can't buy that chocolate. You're a bit overweight today. And, I'm just saying it to get the point across. We've already seen that in Canada, governments, close people's bank accounts down because they were protesting. We've seen in China, the first country in the world to adopt CBDCs, using it as a method of mass control. And of course, we've got social credit systems that mean that, well, I'm sorry, we're not going to be able to lend you so much money. We're going to choose which interest rate you get. I mean, the level of manipulation that's possible with these things is off the charts. And so we do need to be able to free ourselves from the tyranny of central banks. I think we need to be able to adopt private money. It's really important because of this. And listen, I hope that none of these things happen soon, but eventually, if it can be corrupted, it will be corrupted.
Keith, I want to hear your take. I don't know, these central bank digital currencies, they seem kind of cool. I have Venmo on my phone. I can send someone a digital payment now. I can't remember the last time I paid in cash. I've got an Apple Wallet, it just pays like this. This central bank digital currency, it's just the new wave of technology. You don't understand, Keith. Let's hear your thoughts.
Have you ever seen those old Soviet brutalist, art where, the camera was looking up and you'd see this chiseled, Russian peasant with his hammer and his sickle and whatever, and this sort of grim expression on his face. No doubt that in the 1950s, that was cool to, to the Russian people, that it presented their idealized or stylized, sense of life. Getting past the coolness, I certainly agree with, how could anybody not agree with what Jason just said, that this is just ratcheting up the level of control. Now, part of me is just cynical and just wants to say they already basically have the tools for that control anyway, given the, first of all, the surveillance state, the USA Patriot Act, and other things that the NSA has inserted, Echelon and other servers in all the big internet service providers that can sniff all your traffic, anything that touches the payment system, SWIFT, credit cards, bank accounts, they already can monitor it anyway. And they already can dole out, foods, they call it EBT, the food stamp program here, the cards. But this, this ratchets it to a whole nother level of, Orwell. I mean, it's really the only word that comes to my mind. But in addition to that, I would add one other thing, which is, I think what makes CBDCs necessary, and I use the word necessary, if you're the power mad person running the system, if you're the dictator, desperately clinging to power and events are spiraling out of your control, you're desperately taking desperate measures. In the case when the interest rate returns to its collapsing mode, which I predict that it will, when it eventually gets below zero, and gets sufficiently below zero, right? So, if it's 1 basis point below zero, I don't think that really motivates a lot of people to change their behavior. In Switzerland, I don't know if it still is, for quite a number of years, it was minus 75 basis points, minus 0.75% on, not like individual retail accounts, but for larger corporate institutional accounts. So I have a friend who's in the vault business in Switzerland, and they have one of the old mountain vaults that the Swiss government used during World War II to hide gold and munitions and other things. anyway, now it's privately owned, and they put in obviously modern security systems and climate control. They have artwork in there, and they have gold in there, and all kinds of things. And they have corporate and institutional clients who have offloaded 18-wheelers, pallets full of franc banknotes to put in the vault, because the cost of getting those banknotes from the bank and shipping them, obviously that has to be highly secured carrier. Guys with guns have to be escorting that up and so forth. The cost of all that is less than the cost of just simply leaving the balance in the bank. Now that effectively constitutes a run on the bank. That everyone is saying, give me my cash back, which will destroy the banking system. So when the interest rate gets sufficiently negative, then the banking system is going to be a casualty that goes under the bus, or at least the retail deposit taking banks anyway, not necessarily the investment banks and what passes for banking nowadays, shuffling treasury paper around. But when that happens, they're going to be desperately looking for a solution for people to be able to have a deposit account so that they can hold a money balance, transfer a money balance, but that isn't subject to a run on the bank. So they're going to say, okay, we're offering CBDCs, and by the way, your paper notes are no longer going to be legal tender. Bring those in before this date. Otherwise, those are going to be demonetized, and you lose. And unlike the old silver coinage, when they did that, there's no, I hate the term intrinsic value, but there's no intrinsic value to the paper. So when they say the paper is demonetized, that's it. And then they'll force everybody into their, it's like herding all the animals into the pen. Everybody will be herded into the CBDCs, and then they can impose a negative interest rate on your savings account that corresponds to the same negative interest rate that they have on, or that will be the deposit account. Or if there still are commercial deposit taking banks, the negative interest rates will match, and so CBDCs don't offer, or bank, there's no reason to pull cash out of the banks, is the point I'm trying to make. Now people are going to say, what are they going to do about gold or crypto? They don't care, because remember, if you buy gold, that's not a redemption event. That is not forcing a bank to sell assets and redeem you as it was before 1933. It's simply a trade. The person who owns the gold gives up the gold, and the person who has the dollars gives up the dollars. The only thing that changes in the banking system is the name on the record of those dollars. What they're trying to do is control the dollar system and make sure there's not a run that destroys, trillion-dollar balance sheets. So I think, I think they're going to come, because I think negative interest rates are coming. I also agree it's going to be too tempting. It's a one ring, right? That was Tolkien's analogy. It's a one ring of power. And everyone says, oh yeah, I'm going to be Frodo and I'm going to resist the ring. And the moment they see the ring, they all turn into Boromir.
Good analogy.
Give me the ring, Frodo. I will use this ring to do good. And what are they going to do with it? Well, they're going to control our lives. They're going to tell them that we're going to make people healthier by losing weight. And then in the end, it's going to be an Orwellian, nightmare. If we let it go that far, I don't think that. I think the jury's still out. I don't think it's a foregone conclusion that this is, going to happen. If the people say, look, no, then that's it. Just like they said no to masks at the end of the day.
Keith, I find, maybe I can summarize what you said, both of you, for a little old me, 24-year-old. So, we're already not really making much in interest payments on our savings. And if for some crazy reason, a crisis or what have you, the government needs to push interest rates actually below zero into the negative, meaningfully negative territory, most people like me would say, well, listen, why would I put my cash in a bank? I'll just leave it at home. Zero is better than negative, right? But with the central bank digital currency, there is no, well, I'll just redeem what little redeemability I have of my cash from the bank. It has a negative interest rate regardless of whether you want to or not, because your money is in digital format regardless of whether you want it or not. Is that right?
Yeah, they've got you, and they can force you.
Yeah, I think that's one problem, but there are lots of problems with it.
Okay, so I'm going to mark you both down as against CBDCs. and pro gold, you crazy little gold bugs. Okay, so Jason, as we end here, I want to ask you a final question that I ask all the guests, which is, what's a question that you think I should ask all the future guests?
Okay, I mean, there's a question I think that's on everyone's minds right now, a lot of people's minds right now. We saw that the dollar used to be backed by gold, and when we came off the gold standard, we kind of went onto an oil standard. The petrodollar began when the US went to the Middle East and promised to protect them because, with their weapons in return for them using only the dollar to allow purchases of oil. Now, of course, that seems to have been broken, and we have lots of people being able to buy oil now with other currencies. We see the problems since 1971 that all this has created, with a massive creation of debt and the money supply and the system and inherent inflation, all the distorted sides of the economy as a result. I suppose the question could be, how long do you think the US dollar can maintain its status as the reserve currency of the world?
That is a great question and a great way to end. Jason, where can people find more about you and Glint and your work if they're interested?
Well, if you want to put yourself on your own personal gold standard, then I recommend that you go and have a look at glintpay.com. That's glintpay.com, or of course, go onto your favorite app store and download the app. It's available in most countries. Cards that we issue are only available in the UK and the US at the moment, but coming to Europe soon.
Jason, I want to thank you so much for coming on the Gold Exchange podcast, and we'll have to see you soon. Thanks so much.
Thank you.
This episode was brought to you by Monetary Metals. Monetary Metals is a different kind of gold company. Others buy and sell gold. Monetary Metals operates the Gold Yield Marketplace, a platform of products that offer a yield on gold paid in gold to investors and institutions, and are gold financing simplified, reliable financing denominated in gold with a built-in hedge for gold-using and gold-producing businesses. To learn more, visit www.monetary-metals.com. See you next time.